Good afternoon, everyone, and welcome to the BlueKey Market Outlook. Today is April 14th, 2016. I am Bruce Connors. I'm the Chief Investment Officer here. Today we're going to talk about quarter one that just finished on March 31 and take a look forward at the equity markets and markets around the world. So on your screen you see a picture of a roller coaster. This is the Intimidator from the Carowinds Park in North Carolina. You're probably wondering why there's a roller coaster on your screen. But if you were an equity investor in the first quarter, it would make perfect sense. Because basically that's what you were on, a roller coaster. The market went straight down from January 1 to about February 11th, lost about 10%. And then in the back half of the quarter, went up about 13%. Overall for the quarter, you were up 1.33%. That includes dividends. So basically on January 1, you hopped on this roller coaster. And then on March 31st, you got off, and you were pretty much in the same place that you started. These were the news items that moved the markets, and the best analogy I could think of is kind of like a boxer going into the ring, and he gets slugged before he even realizes what happened. So we had negative manufacturing news from the United States and China. The Chinese currency declined in value. Oil was falling dramatically in price. Japan adopted negative interest rates. It was pretty much felt like we were headed straight for a bear market. The market hit its initial low on January 20th. Coincidentally, we held our first quarterly webinar on January 21, and at the time we said that even though the market was down around 14% from its high at that point, that was just in line with your average intra-year drop. We didn't think the market was going to go into a recession. So we didn't think there was much more downside from there, and that turned out to be correct. The market rallied a little bit, then fell back on about February 11th. It hit its low. On that day, OPEC announced that there might be a possible production freeze, and Jamie Dimon sent a very positive signal. He's the CEO of JP Morgan. He bought $26.5 million of his own stock. That turned out to be the market low, and then from that point forward, we had some really solid payroll reports, and the market pretty much went straight up from there. So you can see the blue arrows here. That indicates when China was in the news. The red arrows point to news on oil. The green arrows point to news on the Fed. And the yellow arrows point to positive employment numbers. Looking at the broad asset categories, REITs, real estate investment trusts, were up 5.8%. Same thing for emerging market equities, up 5.8%. Looking at the style boxes, pretty much everything was in the green except for small cap growth. The value stocks did the best. And if you compare that to 2015 off to the right, you'll see everything was in the red except for large cap growth last year. And if you looked what did worse last year, small cap values minus 6.7, and that was the best category in Q1, up 3.15. Looking overseas, a general look at the international markets. This doesn't include the USA. Pretty much break even, down just a little bit, but emerging markets had a really nice run. Looking at sectors, utilities were the big winner, up 15.53%, and the losers were financials and healthcare. Looking at fixed income, emerging market debt denominated in local currencies was up 9.1%. You look at 2013, 2014, 2015 at the bottom, you'll see that emerging market debt was the biggest loser in each of those years. So the pattern, as you can see, really across all these asset categories is a reversion to the mean. Things that were underperforming in the past are catching up now. The aggregate was up 3%. Commodities, again, in a reversion to the mean move. They were the leader. Gold plus 16%, and notice how they were down the last 3 years. Oil continues to be down 12% as measured by the USO, that's an ETF, and commodities overall, the DBC, was down 0.5%. So looking forward, everything we talk about is really with this picture in mind. Are we going to continue on a slow recovery, or are we headed to a recession? We'll look at the United States economy, take a look at China, oil, the Federal Reserve, geopolitical risks, presidential race, technical analysis, and valuation. So let's look at the U.S. economy. These are 5 factors that often precede a recession: accelerating inflation, an inverted yield curve, rising inventory to sales ratio, declining employment, and rising jobless claims. Let's look at each one individually. Take a look at accelerating inflation. The gray shaded areas indicate recessions in the past. If you look at these black arrows, you'll see how inflation accelerated before we entered recessions. Right now, inflation has gone up a little bit over the last couple of months, but it's from an extremely low level, and the overall trend is still down. However, this pattern looks kind of similar to 1960, so we'll have to keep an eye on that. So when I ask the question, do we have accelerating inflation, I think the answer is no, or at least not yet. Inverted yield curve. We're looking at the light blue line. That's the most recent yield curve. That's from 3/31/2016. An inverted yield curve would mean when the front end of the curve has interest rates greater than the back end, and we're not close to that at this time, so we don't have an inverted yield curve. Rising inventory to sales ratio, well, this one we definitely have. Declining employment. Employment has been holding steady of late. And employment really has been the linchpin of this recovery. It's been the strongest factor. So we do not have declining employment, and we don't have rising jobless claims, as you can see on the graph. So overall, you look at these 5 factors, we don't have the conditions that usually precede a recession at this time. This is a proprietary model from Vanguard. The light green indicates what their model is showing as the chance of recession. Down around 5%. However, you look at the blue line, that indicates over a 50% chance of what Vanguard defines as a growth scare. And a growth scare would be a fall in monthly non-farm payrolls below 50,000. So Vanguard expects the rate of hiring to fall, but they don't think we're going to go into a recession. Here are 2 charts from the Atlanta Fed on the left and the New York Fed on the right. Both these charts are kind of calculated as data is recorded. It's kind of like an as it happens prediction of growth or GDP change for the first quarter. So you look on the left, the GDP now forecast. It's come down a lot over the last several weeks, which is not a good sign. The most recent report came out, I think, yesterday, and it was up just a little. So they're looking at Q1 growth of only 0.3% at this time. You look at the New York Fed nowcast on the right, they're looking at Q1 growth of 1.1%. So it looks like we're going to have very low growth for Q1 of about 0 to 1%. Now the only good news is Q1 has been the worst quarter for 6 of the last 7 years, and it's been lower than full year growth during those periods. So the growth of GDP in Q1 has been about 1.9% lower on average than the full year growth. So hopefully, as the quarters progress, we'll see better growth. If you look at the Q2 estimate by the New York Fed nowcast, they're looking at 1.9% for Q2. Let's take a look overseas, and China is really what everyone's focused on. The worry is if China's growth slows, if the currency devalues, it'll bring down the rest of the world economy. That would cause Chinese imports to drop. Chinese exports would increase, and Chinese debt denominated in US dollars would be much more difficult to pay off. But always remember this, China's goal, the goal of the government, is simply to maintain social stability. So they're going to do whatever they can to keep the economy growing and to keep the currency stable. So here's the value of the Chinese yuan, the currency. You can see how it's fallen a lot from 2015 into the first part of 2016. But over the last several weeks, it's stabilized or even gone up a little bit. We think China right now, at least for the near term, has the currency under control. However, we do believe that businesses and residents with money are trying to slowly move funds out of the country. So probably there's going to be a gradual devaluation of the currency over time. But if it's not a dramatic drop, we think the world economy can handle that. Looking at PMI data, this is Purchasing Managers Index data for China. So we're looking here, is there growth in China or not? When you look at PMI data, A number above 50 indicates growth. A number less than 50 indicates a contraction. The services graph on the left, the most recent report just a few days ago came in at 52.2. That's up from 51.2. On the right, the manufacturing data almost was at break even. It was at 49.7. That was up from 47.9. That was the smallest differential from 50 since February of 2015. The good news on both reports is a component of this report is called the New Orders Index, and that was positive, suggesting that recent government fiscal and monetary stimulus is helping boost demand in China. You look at the composite PMI, and this is a combination of the two. It's the black line. That also was above 50, came in at 51.3. This graph compares China's GDP versus Purchasing Managers Index numbers from the past. This is a historical graph, but if you look at basically a little bit above 50 on the PMI and cross-reference it with the GDP growth rate, in the past it's meant GDP growth in China of just under 8%. We don't see China growing by 8%, but we think it's reasonable to conclude they'll have growth between 4 and 6%. Now, if you looked at this same graph in the United States with a PMI of 50, that would correspond to U.S. growth of 0%. But in China, even at 50 or a little bit above, you still have a decent growth. So basically, we think the immediate crisis has passed in January. We're talking about the immediate crisis has passed from what happened in January. The currency is stabilized for now. There'll probably be a gradual devaluation throughout the rest of the year. And then expect growth of around 5% in China. Over the long term, though, China does have issue. It has a ton of debt, and they're going to have to deal with that over time. Around the globe, we're really in a borderline recession. We're still positive, but just barely. Looking at PMI data, again, when it's less than 50, and also when a majority of the countries are reporting PMIs of less than 50, that corresponds to a global recession, as indicated in the yellow highlighted areas. Right now, in the most recent report, we ended up at 50.5, just up from 50. But like the China report, the New Orders Index was very positive, up to 51.2, which was above the 12-month average. So hopefully that's indicating that the global economy will start improving from here. If you look at individual countries, 69% of countries are now in expansion territory. That's the highest level this year. So this is something we'll have to keep an eye on. Right now we're just at the point where we're escaping a global recession. Oil. The concern is lower prices lead to a tidal wave of bankruptcies. There'll be defaults on high-yield debt. That'll spill over into the rest of the U.S. economy. And oil has been a huge, huge drag on S&P 500 earnings. This chart shows spreads of high-yield debt. And if you're looking at the light blue line, that's energy high-yield debt. When I say a spread, we're comparing the yield on energy debt against treasury bonds. So the wider the spread, the riskier the bond is considered. So up until just recently, spreads were getting wider and wider, indicating a lot of risk in the system. However, over the last few weeks, as the price of oil has gone up, energy spreads have come down. So as these energy spreads come down, that indicates less stress on the entire financial system. However, companies are not going to escape without lots of bankruptcies. At some point this year, more than 50% of energy loans will be in danger of default. And all the big banks have been trying to sell off their loans to hedge funds at a discount. They're not renewing loans. They're trying to cut back on credit lines. That's how they're trying to protect themselves. We think most of the big banks are in good shape. If you look at Bank of America, at Citi, at Wells, at JPM, the percent of their total loans to energy companies is in the 2% area. And they've already started writing down a lot of that debt. However, there are some regional banks, and they're not all listed here, a couple are, like Comerica and BOK, that have a substantial amount of exposure to energy loans. But we think the economy has been prepared for this. This is not going to be news, so we're hopeful that the economy should be able to get through this. The price of oil has rallied a lot since the February 11th low. The May futures contract was $26 on February 10th. It's rallied by 54%, was up above $40 as of Monday. The good news going forward for these oil companies is that as we get towards the back half of 2016, inventory builds are going to start declining. So that will help stabilize the price of oil and maybe help it even advance a little bit. You look off on the right here, you can see the huge impact that energy has had on S&P 500 earnings. Taking a look at the Federal Reserve, they raised interest rates on December 16th by 1/4 point, and at that time they said they were looking to increase interest rates 4 times in 2016. We said on the January 21st webinar that we didn't think that would happen. There was just too much problems in the world, and the Fed has backed off. Right now they're talking about 1, maybe 2 increases for the year, and it's even possible for 0. The risk here is if inflation accelerates and the Fed is forced to move faster. But right now the Fed is going to take a very gradual approach to raising interest rates. So can the market increase if the Fed is increasing rates? And the answer to that is yes, based on history. When we're in a slow cycle, which is generally defined as less than 4 interest rate increases per year, the mean increase in the market has been 10.8%. The big geopolitical risk on the horizon is the Brexit. That would be with Great Britain leaving the European Union. They're voting on that in June, and that would have an impact that's hard to measure on currencies as well as equities. The presidential race, we have some unusual candidates on both sides proposing policies that could have an impact on the markets, specifically tax policy, immigration policy. One of the things they're not talking about is structural deficits like Social Security, which is probably our biggest issue. And to me, the biggest threat is when some of the candidates, specifically Trump, are tossing around ideas about a trade war, which could have, I think, a very dramatic impact on the world economy and would probably send the United States and the world into a recession. If you look at the impact of the Smoot-Hawley tariffs from 1930, the market dropped 10% on the day that legislation was passed. People understood what it meant for the world. World trade dropped, imports into the U.S. dropped, U.S. exports fell, and unemployment rose from 6% to 25%. So Trump basically is taking like the worst idea of the Great Depression and doubling down on it. Here is an analysis by Peter Petrie. He's an economist at Brandeis. You could read through it, but it would not be pretty if there was a 45% tariff, as has been spoken about. Same thing here. This is from Moody's Analytics. This was an analysis done. Looking at technical indicators, this is a weekly chart of the S&P 500. The daily trend has been up, and it's been very strong over recent weeks, but the longer-term trend is still down, as indicated by this declining white line. The market is very close to breaking through this, and if it does break through, I would say that the long-term trend has now turned up. But until then, the weekly trend is down. Now here's a daily chart of the S&P 500, and there are 2 things I want to point out here. First, the green arrow, you can see the big run we've had of late, but look on the bottom right, the 2 declining red trend lines indicate a divergence. And what a divergence is while the market is going up in a positive manner, these 2 technical indicators on the bottom, the moving average, convergence, divergence, histogram, and the volume zone oscillator are going in the other direction. Sometimes, not always, there's nothing like always in investing, but sometimes when you see a negative divergence where the market's going one way and technical indicators are going the other, that's an indication that the market's about to go in the other direction. However, this market has simply refused to go down over the last several weeks. If you look inside the blue circles, I count at least 8 different times where the market closed at its low and had the opportunity to follow through and go lower on the successive days that followed, and it simply hasn't happened. So there just is not supply in the market to drive the price down, at least so far. So the market's shown incredible resilience and has really put together a great run here, and we'll see if it can continue. Earnings, while the economy overall is not in a recession, we are definitely in an earnings recession in the S&P 500. The S&P 500 companies had to deal with a very expensive U.S. dollar and the decline of oil, and that really walloped earnings over the last year and into the first quarter. So estimated earnings for the first quarter, according to analysts, is minus 9.1%. But the actual decline will almost definitely be less. If you look at the very bottom of the graph, you'll see that the actual change in earnings is almost always greater than the estimated change. So probably we're going to have earnings of maybe 3, 4, minus 5%, something like that. But more than likely it'll be a decline, which would be the fourth consecutive quarter of year-over-year earnings decline. That's the first time since 2008. Looking forward, for Q2, analysts are estimating a decline of 2.7% for the second quarter. For the third quarter, they're looking for a turnaround, plus 3.8%. And for the fourth quarter, they're looking at a positive 11%. Those numbers are probably too optimistic. They'll probably come down. We'll see what happens. Overall, for 2016, analysts expect plus 2.1% for the entire year. And if you look at earnings by sector, you can see the huge impact that energy has had, and materials also, which is also related to energy. So that's really dragged down earnings for everybody else. So now we're going to try and figure out, is the market fairly valued or not? What we're looking at here is a graph from Morningstar. And Morningstar rates a lot of stocks. So we're looking at all the stocks that they rate, and we're looking at the median stock right here. Is it fairly valued or not? And the ratio is coming in at 0.99. 1.0 would indicate fairly valued. So by coincidence, in this huge universe of stocks that they rate, the median stock is pretty much at fair value. So it's not overvalued, it's not undervalued. This chart here is the single biggest reason why investors want to be in equities right now. The yield on equities, and if you look over to the right in the United States as an example, is greater than the yield on 10-year treasuries. So basically, if you buy the S&P 500, you get a yield of about 2.1% today. 10-year treasury yields 1.79%. So owning the S&P 500, you're getting an extra 31 basis points. Plus, you're owning a company or a bunch of companies that over time have shown the ability to increase sales, to increase profits, and to increase the price of their equities. So you'll get not only the dividend yield, but you'll get a capital gains yield. This is the biggest reason why stocks might be undervalued, not overvalued. And this chart is pretty much showing the same thing. Sentiment is not overly optimistic. If you look at prior declines in the market, and the circles here correspond to about 2000 and about 2008, you'll notice that sentiment, which is on the bottom, up top is the S&P 500 chart, you'll notice that sentiment was always north of 50%. But right now, sentiment is about 32% or so. So the market, investors are not overly optimistic. And that's normally a sign that you see before the market goes way down. The U.S. dollar, you can see the big run-up from 2014 to the end of 2015. That really, really hurt earnings, made it hard for S&P 500 companies to sell overseas, and also when they translated earnings back to the United States. It definitely was a downer on earnings. But lately, the dollar has been declining in value. So hopefully that should help S&P 500 earnings as the year moves on. JP Morgan estimates that for every 2% drop in trade-weighted U.S. dollar, earnings will improve by 1%. Valuation, looking at traditional metrics like price to earnings, price to book, price to sales, the market is overvalued. According to FactSet, and that's their graph off to the right, the 12-month PE ratio is 16.7. That compares to a 5-year average of 14.4 and a 10-year average of 14.2. So the market is overvalued if you look strictly at these metrics. However, these are not usual times. Interest rates are close to zero. As everybody knows, we're in a low interest rate environment, and the Fed has indicated that they're in no rush to make interest rates higher. The rest of the world, same thing. A lot of the rest of the world is in negative interest rates. So taking that into account, we're probably in a zone of fair valuation. And I'm going to read a quote which I read at the last webinar from Warren Buffett, which I think is still apropos. Quote, "The market, based on normal interest rates, is on the high side of valuation. Not dangerously high, but on the high side of valuation. On the other hand, if these interest rates were to continue for 10 years, stocks would be extremely cheap right now." End quote. So where are we overall? Why might the market go down? These are some of the negative factors on the left. The price of oil, it's better than it was in January, but it's still very low, still making it extremely difficult to make any money. That means there are going to be several bankruptcies, or more than several, many bankruptcies for oil companies. The presidential race brings a lot of uncertainty to the market. The long-term trend right now is still down despite the rally of the last several weeks, although it's close to changing. So we would consider that a negative at this point. And most of all, the valuation, the price to earnings, price to sales, price to book, based on traditional metrics, the market is overvalued. On the plus side, the U.S. dollar is no longer going up, at least for now, and it's come down a little bit. So that won't be a headwind for S&P 500 earnings as the market moves forward. The short-term momentum in the market has been very positive. The market's been very resilient, hasn't gone down, continues to go up. We'll see if that can continue. Sentiment is not overly optimistic. That's a positive sign. And the Fed is going to move very cautiously, very slowly. That will be supportive of equity markets. And central banks around the world are on the same page with that. And then most of all, dividend yields indicates the market is actually undervalued, and stocks are a good long-term investment here. The global economy and the U.S. economy, we kind of put that in the middle. We're not in recessionary mode, but we're not really growing either. So overall, we'd give a very slight tilt towards the bullish side. The main thing to remember, though, as an investor, is look at your time horizon. If you're looking forward, if you're a long-term investor, you definitely want to have an allocation towards equities. That's our presentation for today. If you have any questions, please contact Amari or myself or Robert at the number above. Also, please make sure you're signed up for our new weekly commentary. That'll keep you filled in on what's going on with the markets between our quarterly webinars. Thank you very much for attending, and please contact us with any comments or questions.